just a highlight of what VAT is all about. VAT is the difference between the tax on sales and the tax on purchases. And that's why we say that VAT payable is the output tax. Output tax is the VAT on sales minus the input tax, VAT on purchases. So this is April 2025, question number 2C. Now, Bandika Enterprises Limited deals with both vertable and non-vertable.
Excuse me. Which question did you say? Which year?
April 2025.
Okay.
April 2025, question 2C. And we are doing this with an assumption that you guys got some time na mkapitia zile videos tulishare, so that we just do a question to try and highlight any of the challenges you may have faced. So let's look at this question 2C of April 2025. That's the sitting before hours. Bandika Enterprises Limited deals with both vertable and non-vertable supplies. The following transactions were obtained from the accounting records of the company for the month of March 2025. So we have sales at standard rate sales, they attract VAT of 16%. Purchases at standard rate, they attract VAT at 16%. Exports to Zambia, I believe we appreciate that all exports are zero rated. They attract VAT at the rate of 0%. Then we have exempt sales. Exempt sales, they must take us to that point of restriction of input tax. So they need to take us anyway. Anytime you're going through a question on VAT and you see something to do with the exempt sales, be very careful to confirm if all input tax is supposed to be claimed or you're supposed to restrict it. We shall check that. Then we have stationery. When you buy stationery, that's a purchase, it attracts VAT. Audit fees, that's a purchase, you are purchasing that service, it attracts VAT. Catering expenses, I believe from our notes, the catering expenses are prohibited supplies. You're not allowed to claim VAT on it. And under prohibited supplies, we had several items: the restaurant services, that is catering and accommodation. We also had purchase of fixed assets. It's a prohibited item. And we also had the oil and lubricants fuel and lubricants for motor vehicles. All those we consider them to be prohibited. Prohibited means that wakati unanunua utachajiwa VAT, but you can never claim that VAT, meaning that like now when you buy fixed assets to use in the company, the concept of VAT is always about VAT in, VAT out. You pay VAT while buying, knowing that you'll sell them and recover the VAT. So if I buy a fixed asset, there's no way I'm going to recover that VAT because I'm not buying to sell, I'm buying to use. And that's why the fixed assets, the VAT in it is prohibited. You'll be charged VAT while you buy that asset, but you can never claim it. You're prohibited from claiming it. So that VAT on fixed assets will form part of the asset and it goes to capital allowance. The VAT on fuel that we buy, it forms part of the cost of the fuel and it is expensed in the P&L. Now, the company issued credit notes worth 53,360 for goods wrongly priced. Now, the issues of credit notes and debit notes, hizo lazima tuzi-understand. And we must understand from the perspective of their interpretation. And you know that a credit note is meant to correct an overcharge. Ulifaa ku-invoice mutu 500,000, but ukamu-invoice 560,000. You appreciate that umemu-overcharge. So you issue a credit note. A credit note is more of like a refund. So it corrects an overcharge. With the same note, debit notes corrects an undercharge. You are to invoice that person 500,000, but you invoiced him or her 450. So you issue a debit note appreciating that he owes you or she owes you. So it's a confirmation that you paid me less. So increase top up. That is for the debit note. For the credit note, come for the refund or you come for more goods. Now, after appreciating what the debit notes and credit notes stand for, we now come back and appreciate that when they are issued, anything issued, it's always issued to the customer. Anything received, we receive from our suppliers. That's why you have the discount received. We receive from the supplier. So we issue to customers and we receive from suppliers. In simple terms, any debit notes or credit notes issued, they are affecting our sales. Credit notes or debit notes received, they are affecting our purchases. So the company issued credit notes. Issued is the big word here. So it's going to affect our sales. So they issued credit notes worth 53,360 for goods wrongly priced. So meaning credit notes corrects an overcharge. So it's an overcharge of our sales because we are issuing to customers. Kama ingekuwa received, it would be an overcharge of our purchases. The company received debit notes worth these for goods underpriced by suppliers. So suppliers walitu undercharge, wanatupea debit notes to confirm that watulilipa less tuongeze hiyo amount. A debtor of goods valued at 2880 was declared bankrupt and the amount owed written off as a bad debt. Ulikuwa umeuza ukaclaim the output tax, huyu mtu imekuwa declared hatalipa. Just reduce your sales because there's a confirmation that you'll never recover that amount. Remember, VAT is payable by 20th of the following month. So you already paid VAT on that amount, but now you discover that you'll never recover it. So also recover your VAT that you paid. A customer of goods valued at 9280 returned the goods to the business and the credit note issued immediately. So credit notes issued to the customer, it's reducing our sales. 20% of purchases at standard rate could not be directly identified from sales at standard rate and exempt supplies. All transactions are inclusive of VAT at the rate of 16% where applicable unless otherwise stated. So let's see. So they want us to get the deductible input tax, the output tax, and the VAT payable. So in our workings, we can start with the output tax. And the output tax from the schedule that we always have, we have nature of supply. Nature of supply, we have value for VAT. We have VAT rate. And we have VAT amount. Sorry. So nature of supply, value for VAT. And one thing that we must always appreciate, that value for VAT is always 100%. So if the transactions are inclusive of VAT, be sure to take them back to 100%. So in the same concept, I always like killing two birds with one stone. We talk about hapa chini yake, input tax. Input tax, we have nature of supply, it's replicated. So there we go. Now let's start. We have the standard rate sales at standard rate. So that's an output tax. So you have standard rate sales. Because the figures are inclusive of VAT, they are inclusive of VAT, meaning iko na VAT ndani, we take them back to 100%. So 100 over 116 times 9810, 816. So if the transactions are inclusive of VAT, please be careful. Take them back to 100%. That means those transactions are at 116. So 16 over 116 times that amount. So the VAT rate is 16%, and the VAT amount becomes 16% of these. So hiyo tunakuwa nayo hapo. So that one, haya, tuko na standard rate purchases. Standard rate purchases. So the transactions are inclusive of VAT. So if that amount is 100%, what is 160? Or if that amount is 116%, what is 100%? 100 over 116 times 6521, 6521, 984. So there you go. The value is 16%. The rate is 16%, sorry. So we have that there. Exports to Zambia, that's a sell. They have exports to Zambia. All exports are zero rated. So the value is 400,000. The rate is 0%. And therefore, the VAT rate becomes 0. Kindly, it is 0, not dash. There's a difference between dash and 0 in VAT. Dash is exempt, 0 is zero rated. Those two are different. They have very different. So ECS yenye unasema the 0 and dash is the same. Hapana. 0 for zero rated, dash for exempted. Then we have exempt sales. So exempt sales valued at 250. So the rate is dash, the VAT is dash. Aha. Stationery we purchased, kwa hivyo inakuja hapa chini. Transactions are inclusive of VAT. So 23,200 times 100 over 116. The transactions are inclusive of VAT, very important. So the VAT is 16%. So that here becomes 16% of the audit fees, that's the purchase. The audit fees 174,000 times 100 over 116. So 16%, which equals to 16% of the value without the VAT. Na ukiangalia vizuri hii 24,000 is actually 174 minus 150. 3,200 is 23,200 minus 20,000. So is the aspect of VAT in the figures. Then you have catering expenses. Catering expenses. So you have 69,600. So it's prohibited. Anything prohibited, we put a dash. Now the company issued credit notes worth 53,360 for goods wrongly priced. So issued, anything issued is affecting our sales. So we have credit notes issued. Credit notes issued. So credit notes issued, the company issued credit notes of that. So it's supposed to correct an overcharge, meaning we are going to less. So we are having 53,360 times 100 over 116. So hiyo tuna less 16%, and that one becomes 16% of these. So hiyo tuna less, there's a negative there. The company received debit notes worth 41. So we received, it's affecting our purchases. So debit notes received. So anything debit notes increases the figure. Anything credit notes reduces the figure because debit notes are correcting an undercharge. So 100 over 116 times, we received debit notes of 41,760. So equals 16%. So 16% times these. Great. Then we have hivyo tu tunaendelea nayo vile iko tu. A data of goods valued at 2880. So tulikuwa tumemuuzia, it has to affect our sales and we call it bad debt relief. It's called bad debt relief. So 100 over 116 times data alikuwa na 2880. And this is a negative. So there we go. Hope I'm not so fast for you. Then note number 4, a customer of goods valued at 9280 returned the goods to the business and a credit note issued. So we issued a credit note. So hapa tuko na credit note issued. So customer of goods 9280 times 100 over 116. So because it's a credit note, it must correct an overcharge. Tulikuwa tumemuuzia, so tunapunguza sales zetu. So 16%, and we have that 1280. Then finally, 20% of purchases at standard rate could not be directly identified from the sales at standard rate and exempt sales. So at that point of restriction of input tax, we said that there are two ways of restricting the input tax depending on the information provided. Now, one of the ways, we had the proportional method and we had the allocation method. Proportional method is very direct. This question, the note number 4, tells us that we can allocate, we can identify some input tax that can be traced up to the output tax. Tukinunua tulilipia VAT, tukiuza hatukulipia VAT. Sorry, tukinunua tulilipia VAT na tukiuza pia tumeconfirm tulilipia VAT. And that is the 80%. So let's have total sales. Let's have output tax, which is the total of these. And the total sales, the summation of that. And we have the input tax, which is the total of that. Now, let me clarify two things here. Number one, kama hatungekuwa na exempt sales, input tax ingekuwa the 932. Output tax ni 1341. VAT output tax minus input tax. Hizo maswali tunamaliza. But because we have exempt cells in this question, because of exempt cells, normally we always say we carry out the 10% test. And 10% test, we ask ourselves, how much is the exempt cells as a percentage of total cells? What is exempt cells as a percentage of total cells? If the exempt cells are more than 10% of the total cells, then you have to restrict the input tax. Inamaanisha kuwa wakati ni vitu mingi sana ulichajiwa VAT ukinunua na umeamua kuziexempt wakati unauza. So in our case, we have exempt sales of 250,000 and we have total sales of 35,000. So if we take 250,000 and divide by 35,000, and to make it a percentage,
it's 90/35/600.
or 90/35/600, thank you. 90/35/600. So here, oh, this already tells us the exempt sales are more than, sorry, the percentage of exempt sales does not exceed 10% of the total sales. And because it does not exceed 10% of the total sales, we just appreciate kuwa the 2.77% is less than 10% of total sales. Hence, input tax is not claimable, is not restricted. And if it is not restricted, in answering the first part, the deductible input tax will be equals to ile tulikuwa tumepata 932,544. Then the output tax equals, tuko nayo 1341,696. Hivyo tu, but I'm going to explain what happens if it's more than 10% so that we learn through this. And for that reason, VAT payable equals output tax minus input tax. Our output tax is 1341,696 minus input tax ambayo tumepata 932,544. So there we go. So unless there's a question, can be allowed to clarify. If you had carried out the 10% test, now part of this amount is more than 10%. Let's say, for instance, maybe it's 12%. Then in such a case, just clarifying what would have happened if if exempt sales were more than 10%. Now, hii concept ya 10% test inamaanisha kuwa the commissioner allows us to exempt sales up to a maximum of 10%. 10%, he allows us to have at most 10% of the standard rate purchases to be sold as exempt sales. Remember, ukichajua VAT ukinunua, unafaa urecover hiyo VAT ukiuza ili uweze ili usiweze kusuffer the pinch of VAT, because the VAT, whoever feels the pinch is the final consumer, not the trader. So VAT on sales minus the VAT on purchases. Ukinunua ulichajua VAT, that is a cost to you. Ukiuza utacharge VAT. Then after kucharge VAT ukiuza, you will claim what you had paid earlier and you give the government the excess. And that's why this company, Bandika Enterprises, while buying these products, they paid VAT of 932,000. While selling, they charged VAT of 1.3 million. So instead of giving the government the 1.3 million, the government allows it to recover what it had paid and now give her the balance. And that's why the tax incidence and the impact, the incidence of taxation to VAT is to the final consumer. Haya. Now, assuming this was more than 10%, hapa tungekuja tukasema, so allow me to hide this a little bit. So assuming this figure was probably, let me just say 12.7%, which is more than, so this would be more than 10%. And for that reason, we restrict input tax. We restrict input tax. And in restricting the input tax, we using allocation method. Why allocation method? Because of note number 5. There are some goods that can be spotted, which tukinunua tulichajiwa VAT ya 16%, tukiuza tumecharge VAT. So 20% cannot be directly linked, meaning the balance of 80% could be directly identified from the sales at standard rate and exempt supply. So ukinunua ulichajiwa VAT, ukiuza ulicharge VAT. So therefore, in our allocation, we look at input tax in identified goods. Sometimes we'll say input tax not in the mixture. So input tax in identified goods. We cannot identify 20%, meaning we can identify 80% of our input tax 934,544. Now, first of all, you identify the goods that are not, you separate those items. Out of the 100% of our purchases, 20% could not be directly traced into our sales, meaning 80% could be directly traced into our sales. We don't have to restrict that one because ukinunua ulichajiwa VAT, ulikiuza ulicharge VAT. You don't have to restrict. It's not part of your exempt sales. Then after identifying that, the input tax that remains, so the balance is the input tax to restrict using proportional method. Using proportional method, which is the remaining 20%. 20% of 934,544. So this is the input tax to restrict, and you appreciate kuwa input tax claimable. Input tax claimable. If you can recall the formula from our notes, we talk about vertible sales divided by total sales, and all these we multiply by input tax. We multiply by the total input tax. So input tax restrictable. Let me put here input tax restrictable. And from our sales zetu ziko hapa, so we know that vertible sales is the standard rated sales plus zero rated sales. So all these are vertible sales exempt the 250. 250 ndio exempt peke yake. So therefore vertible sales equals to 90,35,600 minus 250,000. Hiyo inabaki ni vertible. So we have 90,35,600. 90,35,600 minus exempt sales, which were 250,000. So that becomes the vertible sales. And all this we divide by total sales, ambazo ni 90,35,600. Vertible sales divide by the total sales, which is this. And all these we multiply by the input tax restrictable, which is 186,508.8. There we go. So this is what we restrict. Vertible sales over total sales times the input tax restrictable. Then we add that input tax that was not restricted, input tax in identified goods. which was 747, 635.2. Alafu sasa hiyo total ingekuwa total input tax claimable.
No one's in trouble. Bingo just has something she'd like to tell Sam. That's all.
Now you see, just some clarification. Because of restriction, unaona input tax tuna claim ni kidogo compared to the input tax that we claimed without restricting. Without restricting, it was 932. After restricting, is 928. The concept of restricting is to reduce so that the government can remain with more. Ukireduce ile amount ya kusubtract, the resultant amount will be more. Unless there's a question. So kama hii note number 5 haingekuwa and you're supposed to restrict, then everything else would be the same. The only thing that would not have is this one. Hii haingekuwa. So hii story iko hapa yote haingekuwa. Hii story iko hapa yote haingekuwa. The only thing ingekuwa. So unakuja hapa. Unakuja hapa, unachukua the vertible sales over total sales times the total input tax. So 9035 minus that to get the vertible, divide by that times the total input tax ambayo ni hii. Kwa sasa hapa hakuna ya kuiseparate. Any swali? Great. We can look at question 2C of December 2024. December 2024, question 2C. So there's a different approach to the question. Delight Limited, a company registered for VAT purposes, provided the following details for the month of October. Purchased raw materials from Dubai for that, inclusive of import duty at the rate of 25% and VAT at the rate of 16%. The raw materials were transported to business for further processing. The processed goods were later sold on 8th October at this amount inclusive of VAT. So note number 1 iko na input tax na iko na output tax. Tumenunua, tukachajiwa import duty na tukaongeza VAT ya 16%. Alafu tukaziprocess na tukaziuza. So kuna both input na output. Number 3, on 3rd, purchased goods from suppliers for this net of VAT. Net of VAT, is it inclusive or exclusive? Net means without. So that is 100%. So net of VAT after deducting VAT. So out of which 20% were from unregistered suppliers. For you to charge VAT, you must have registered for VAT. Otherwise, you cannot charge. So meaning hapo hakuna VAT kwa unregistered. Paid for audit and accounting services amounting to 290. That's input. Sold goods to a client in Rwanda. Rwanda, we are exporting, so zero rated. Sold goods on credit to member traders based in Mombasa for 835,200. Member traders paid 320 during the month, and the balance to be paid in the following 2 months. The tax point. When VAT is due, the earlier of when goods or services are delivered, when payment is made, either in full or partially, when an invoice is issued. Haya. So, Delight issued credit notes to the client in Rwanda for defective goods worth 60,000. So those are he issued, meaning it was about the sales. Na ni zile exports. Purchased computers for resale. Remember, for resale on higher purchase price for 420 exclusive of VAT. Higher purchase interest was 92,000. So in case of higher purchase, the cost price is the value for VAT. Higher purchase interest inaenda kwa income statement. Nakumbuka the computers were purchased for resale. Kwa hivyo ni stock. Hiyo ni stock ilinunuliwa. The directors of the company took goods worth 160,000 from business for their personal use and donated goods worth 240 to Neema Children's Home. So when you make some drawings of goods, hiyo ni sawa na kusema tumekuuzia. Anything VAT in, VAT out. So even the donations or gifts, they must attract the VAT. They must constitute a sale. Then the donation was to a children's home. Donations to a charitable institution is always zero rated. They are called privileged persons. The presidency, charitable institutions, diplomats for the first 100 days of their stay in Kenya, the armed forces, and the special the goods that are sold in their canteen. That's why ukienda kwa canteen zao, goods zinakuanga cheaper huko. It is the policy of the company not to charge VAT on drawings and donations. Hiyo ni uongo. It should never happen. Unaweza kuletea kitu kama hii, then they ask you advice on any consequences. Identify any flaws in the policies in the policies of the company. That kuna flaws hapo. We should always charge VAT on drawings and donations. A customer who was declared bankrupt paid the debt of goods amounting to 100,000. He owed Delight. And Delight had claimed a bad debt relief in respect of the debt. So ulikuwa umeclaim bad debt relief hapa, alafu customer amelipa. So ongeze tu, rudisha tu hizo goods, ulipie VAT. Paid for the following expenses: bottled water for directors. Bottled water hiyo iko na VAT. Now, zile goods zinakuanga zero rated ni goods ambazo kwa tunasema mwananchi wa kawaida anazihitaji. And I want us to take it from this point. Maji ya Kanjo iko zero rated. Bottled water iko standard rated because the commissioner appreciates if you can afford bottled water, well, you are well off. Unga wa ugali kwa supermarket zero rated. The wheat flour standard rated. Fresh milk, 0 rated. Yogurt or mala, standard rated. So if there is some prestige associated with that product, unachajiwa VAT. But if it's there to serve all the clients, all the people for a common good, then it's likely to be 0 rated. So bottled water to charge VAT, rent for the business premises to charge VAT, private parking for business vehicles to charge VAT. Parking ya kanjo, county government parking, VAT ni 0. But private parking tuna charge VAT. Transactions are inclusive of VAT. Compute the VAT payable by or refundable. So from this information ukiangalia vizuri, hakuna mahali tumeona exempt sales. Hakuna mahali tumeona exempt sales apart from, actually hakuna, because tuko tuna exempt suppliers, not number 2, wale wenye hawako registered. So we borrow the same concept. We borrow the same concept. So we have input VAT, input tax. So let me put it here for the output tax. And we also put here our input tax. So we kill the 2 birds with 1 stone. We can document those 2. I hope we are there, all of us. So I start with tarehe moja. Purchased raw materials from Dubai. So hapa tuko na purchases. Purchases. The 2981 is inclusive of import duty at 25% and VAT at the rate of 16%. So meaning import duty na VAT zishachajiwa. So that is 2981,200. 2981,200 times 100 over 116. The transactions are inclusive of VAT and also inclusive of the customs duty. So when you look at this, haina anything to do with the exempt sales. So hakuna hata restriction. So VAT rate is 16%. So VAT amount equals 16% of these. So you have it there. Hey. So Alafu the raw materials were transported to business for further processing. The processed goods were later sold inclusive of VAT. So tuko hapa na sales. Sales, they're inclusive of VAT. So 100 over 116 times they were sold at 47,85,000. 47,85,000.
31, 3, 1. 31.
So which equals to this VAT 16% of that. So not number one sorted. Next time watakwambia the imported goods from Dubai are the cost, insurance, and freight of these. So if this is only the CIF cost, insurance, and freight, kindly add the import duty, 25% of that. The total amount will be the one to attract VAT. Value for VAT is value for duty plus duty in case of imports. Cost, insurance, and freight plus the duty. Unapata hiyo total, ndo weke VAT ya input tax. Uongeze the value yenye utaongeza, upate the total sales, weke VAT ya sales. Tarehe 3, purchase goods from suppliers for 38,40,000 net of VAT, out of which 20% were from unregistered supplies. So you have purchases. So we have purchases from unregistered suppliers. Wamesema ni 20%. So this is 20%. So equals to 20% of 38,40,000. So unregistered, they cannot charge VAT, not even 0% exempt. Then you have purchases. You have purchases from the registered suppliers, which is now the remaining 80%. Now lisema it is net of VAT. So meaning your amount already near 100%. 80% of 38,40,000. So hapa tuweke VAT ya 16%. Na hapa tupate amount of VAT 16% of that. So they are, these ones net of VAT, they are exclusive of VAT. So you don't do times 100 over 116 again. Tarehe 8, paid for audit and accounting services amounting to 290. What were you told hapa chini? Transactions are inclusive of VAT where applicable unless otherwise stated. So akiwa kama hawajasema chochote, they are inclusive. Payment ni input. So you have audit and accountancy and accounting fees. 100 over 116 times 290,000. Tunaweka hapa 16%. So that's 16% of that, 40,000. Number tarehe 12, sold goods to a client in Rwanda. So sales to Rwanda. It sold goods to a client in Rwanda 720. So it's zero rated, kwa hivyo C116. 720,000. The VAT is 0%. And the VAT becomes this times this. So inakuwa 0. Sold goods on credit to member traders. Sold goods on credit to member traders based in Mombasa. So I have credit sales. Credit sales. 835,200 times 100/116. Ni nini ingine wametuambia? Member traders paid 320, no problem, during the month and the balance to be paid. Bora umeuza goods, you don't wait because VAT on those goods is supposed to be paid by 20th of the following month. That's why we have debit notes and the credit notes, and we have the bad debt relief. So ingine isipokuwa recovered, tutapeana bad debt relief. Tarehe 20, Delight Limited issued credit notes to a client in Rwanda. So credit notes issued, we issue to our clients. Credit notes issued. We issued credit notes valued at 60,000. Ilikuwa exported. It's meant to correct an overcharge. Exporter 0 rated. And here we subtract 0. Uh-huh. 24th purchased computers for resale on hire purchase. Purchases ziko hapa. Computers, and remember in our case, computers ilikuwa stock. See fixed asset, they purchased for resale. In case of hire purchase transactions, the value for VAT is the cash price. So 100/116, what is the cash price for that? 90, purchased computers. Hire purchase interest was 92. So therefore, 420 minus 92. 420,000 minus 92,000. So the difference between the higher purchase price and the interest is the cash price. So you have the VAT. So there you go. What else have we been told? The directors of the company took goods worth 160,000 from business for their personal use. So you need drawings. Drawings ni sawa na sell. Drawings by directors. Tukinunua hizo goods tulichajiwa VAT. Tunatarajia kuwa tutaziuza na tucharge VAT. So you look at the current market price. So they were worth 160,000.
Those having been really mostly honest as they come.
So ni sawa na sale yenye tumemake. And we have donations to children's home. Donations to children's home can be a donation or even a sale, as long as it's charitable institution, rate yake ni 0%. So donations walidonate ngapi? 240,000. So it doesn't have the 16% in it. It has the 0%. And that's why after VAT, VAT yake haina effect, ni 0%. A customer who was declared bankrupt in May paid the debt. So recovery of bad debt relief. Ulikuwa umeclaim bad debt relief, amaamua kulipa, rudisha penye ilikuwa so that ulipie VAT. So 100 over 116 times the customer valued it how much? 100,000. So there we go. The VAT on it tuko nayo hapo. What else do we have? Purchase goods for cash amounting to 1240. So you have cash purchases. Zote ziko na VAT. 100 over 116 times 1240 times 1240. We charge the 16%. There we go. Almost there. No, purchases iko huku chini. Sorry guys. Purchases si our input, purchases si output, purchases ni input. So ni kwa input tax. Sorry for that. Then finally, paid for the following expenses. We have bottled water. So bottled water iko na VAT 100 over 116 times 30,000. A 100 over 116 times that. We have 16%. Kama ingekuwa maji ya kanjo, ingekuwa 0%. So value yake pia ingekuwa 100 over 100 because si 16 imechajiwa hapo. Tuko na rent. Rent attracts VAT. 100 over 116 times 48,000. So you have it there. And finally, we have private parking. Private parking, 100 over 116 times the private parking cost 30,000. So that one gives us that. That attracts VAT of 16%, and we have that. And with that one, by the way, tumemaliza. So because hakuna restriction of input tax, you simply get your output tax which is the sum of these, is the sum of that. And you have the input tax, which is the sum of that. Simple as that. I hope we are all together. Na unamwambia kuwa VAT walitaka VAT payable. VAT payable equals to, so as I was saying, our VAT payable simply becomes the output tax minus input tax. So output tax is 811,062 minus input tax of 1173,892. So equals to this minus this. And now this becomes, nawambia tu hapo chini, it's not VAT payable, it's VAT refundable.
15. 15. 15. 15. 15. 15. B. T. 50.
There we go, unless there's a
Okay.
question.
Still 15. 15. B. 15. 15. 16. 15. 15. Mama. 15. I'm just 16.
Any question from what we've covered? So that is it with VAT. So we can practice more questions. We'll get some challenges, you kindly share, so that we did capital allowances. And if somebody can remind us.